And joining me on the podcast right now is Paul Hill. He's a full-time investor, equity analyst. He's got his brain around more stocks, and we've had hot dinners. Unbelievable. I don't know how you keep up with that, Paul, because I often said for a while back, I had option paralysis, too many stocks. When I started, I didn't know where to look. There's big caps, small caps, there's overseas. And I'm amazed how you can keep track of so many stocks being an analyst at that.
Well, I would say I'm hopeless compared to Paul Scott, who I spoke to at the weekend, who's a sort of like a real expert at sort of all things small cap. And I interviewed him, so I'd encourage everybody to have a look at that. But he told me, he looks at a regular basis, 500 stocks. And I said to him,
you can't monitor 500 stocks. How do you do that?
I said to him, do you ever sleep? And he says, well, I've been tracking them for like 15 years, so I've got a lot of history.
Oh, okay. That's so build up. Yeah.
Yeah, but he's basically a walking library on all things AIM and small cap. So he was brilliant to talk to, and he's got some great ideas. Both. I
watched that, and do you know what was one thing I would say is I still find that even if you've built up knowledge, because I've been in the markets for like 20 years and properly the last 10 years, I suppose. But I got to this point where I thought I need to specialize. Because I've dabbled. I started off with big caps. I think most people do that. Well, at this day and age, it's probably crypto and all that stuff. But most people start with big caps. And I sort of there's more gains to be had in the smaller cap space. They're more volatile though. But then I needed to specialize a bit, because I thought there's so many opportunities. Like you say, you get companies like, for example, Boohoo. I mean, that's dropped, for example. There's a play there. But I thought I've got to limit myself and be disciplined and try and specialize in an area I like, I find quite exciting, I can get a handle on. And so I sort of gravitated towards smaller micro caps, And so that way, setting up a filter and strategy, I can sort of reduce the risks in some way, and get the good gains. But yeah, I find it really hard. I mean, that's one of the things about the market, having too many options. It can make your decisions poor, because you can think, oh, should I do that? Yeah, because I see so many options on Twitter all the time. This has dropped off. That's a good company. It's right. You see these big companies like Boohoo, for example. There's opportunity there, but you've got to limit your. You can't be capitalizing into everything. And I was surprised how many stocks he held, and the percentage he held in any one stock. I thought, how do you make a gain off that? So
yeah, he's done really well over the time, so it works for him. But I would say your strategy of sticking to your knitting, only invest in areas that you've got deep expertise, definitely is the thing to do. No doubt about it. Albeit the overlay for that is that you've got to look at sufficient areas to give yourself diversification, or some level of diversification. Because if you decide, let's say, for instance, I'm just going to be an expert in all things EV, well, that's great if electric vehicles do really, really well. But frankly, at some point in time, they'll have a wobble or whatever it is. And therefore, all your portfolio, if you've only invested in that, will come down. And that's, again, fine if you can take that level of volatility and risk, i.e. see a drawdown of 50 or 60% on your total portfolio. So I would say is such that, yes, invest in things you are comfortable in, and that's the Warren Buffett way, and certainly yours and mine as well. But give yourself sufficient breadth of knowledge of those areas to give yourself some diversification. And leading on to that, I've gone numerous ways. I started in big caps, I went into small caps, and now I do the whole lot, both the UK, US, and Europe. And the reason that is because there's opportunities everywhere across different sectors and in different size companies. And I'll just give you an example. I mean, yesterday, one of the companies, you'll yawn, but one of the companies that I own, Aviva, reported results. And they're just doing what they said they would do. 18 months ago, the new CEO, Amanda Blonde, said she was basically going to restructure the business. She sold off a lot of her foreign companies. They're focusing on the UK, Canada, and Ireland now, rather than places in Europe and Singapore and Asia and all these kind of other places. And she's got sort of like she's managed to collect £7.5 billion, and she's got over £4 billion, probably £5 billion of surplus capital. And just to give you an indication, £4 billion is roughly round about £1 a share, just over. The shares are currently just over £4. So you've got another £1 coming back to shareholders in either probably buybacks or some sort of form of dividend. And they've got an activist investor in there called Saietta, who realizes actually you can squeeze this lemon even further. Oh, that's not. We shouldn't have called it leverage. You squeeze this orange a bit further, and they want £5 billion back to shareholders. That's another 25p. So this has really been a bit of a no-brainer for And I talked about it 9 or 12 months ago when I bought it, and it's been tracking up. I bought it around about £2.60, and it's about £4. It's paid really good dividends since then. It's approaching fair value, so I'll probably sort of like drop out of it late, over the next 6 months. But I think they're still going to. The key going forward, and if investors are in there at the moment, the key going forward is to improve the return on equity. It's about 8% at the half year. If you reduce the capital base with a surplus capital return of 4 billion, you should be able to push effectively the return on equity from 8% at the half year to around about sort of 13%. And if you can do that, that's going forward on a higher profit number by reducing the cost base as well. And therefore, you should be able to track up easily to your sort of your net tangible book, or just your book value, which is about £4.50 or £5. And so on that basis, there's still plenty of juice left in Aviva. So I'm happy to hold, but if I do see other opportunities, given it to the liquidity, I'll use it as an ATM. I'll just use it as I'll sound the register and move on. So coming back to your theme.
I mean, when you say that though, I mean, I like I always love your stats and facts and see what you're looking at. The metrics that to mean a lot to you. I like that a lot. But I mean, when I'm not an expert in EV. I look at the way I filter is basically I will look for hot trends, hot mega trends that can last for a long time. I mean, the biggest at the moment is the energy transition. I'm looking into that. I'm very excited about that.
Okay, here's a question for you. Just on your EV expertise. It's a bit of a trick question because you haven't yet seen the answer, but I don't know. What is the projected addressable market for electric vehicles in 10 years' time?
The total addressable market in 10 years' time. Are they saying I knew there's a figure of they wanted to get right 30% by 2030 was that was the figure the EVs were pushing for. I think it's at about for the moment 3-4%, isn't it? Maybe something just 5%.
Yes, you're right. Yeah, you're getting closer there. Yeah, but no, in money terms, in value terms.
Oh, I don't know in money terms. I have no idea.
Okay, well, I recommend you and all the other investors who are sort of like want to talk about with the electric vehicles. I did an interview which hasn't yet been published, I don't think, but it's with a super smart tech and software guy from Wedbush Securities. It's the latest edition of Voice on Wall Street. Anyway, it's a guy called Dan Ives. He's absolutely brilliant, but he loves EV and also Tesla. And he took me through the whole thing. And the answer to the question, $5 trillion. $5 trillion. I'll repeat that. And he says Tesla currently has got an 80% market share in the US of electric vehicles. You rightly point out this is the number one.
Yeah.
Effectively.
Do you want a big figure? Do you want a big figure than that? Listen to this. This is Bloomberg's, and they're saying to achieve net zero carbon emissions by 2050 will require $173 trillion of investment in the energy transition. That's how much is going into it. And I'm looking at EVs. I mean, green hydrogen, all that stuff. I mean, that's a very exciting area because the thing holding it back at the moment is cost, but that will come down, because it has to. And the investment going into that is phenomenal. And they're saying that even by sort of, they reckon in their green scenario, it'll be sort of it'll probably 70% of energy will come from solar, wind, green hydrogen by 2050. So that's a huge. And if you look at the graphs and say green hydrogen, phenomenal amount of demand, and all the big players are getting into it. I mean, talk about Ineos, Shell every day they're doing something about green hydrogen. So I think if anything, and it benefits green hydrogen benefits sort of HGVs. It's funny looking at Elon Musk talking about trucks and stuff. I know he's been quite slow on that because it doesn't benefit batteries. Their power density doesn't benefit big vehicles. So trains and HGVs it works with hydrogen because you fill it up at the same time you can have with diesel, and it's the same power density as diesel pretty much, which batteries is not. You need a lot more space, and therefore more space is heavier, taking up more cargo space. So it's worth it. Because I mean, just saying the energy transition alone is the biggest But I mean, it's the end of the planet, according to some people, of course. So it's got to be. It's the biggest trend around. So I think, as far as exposure is concerned, you've got to try and get some exposure to this area because it's going to be massive for years to come. You know, and so that's why
one way of getting exposure. And they came out with an acquisition yesterday. I don't know if you saw it. It was Saietta, and we've talked about
I saw that.
These
Very
guys.
interesting.
They
steel, wasn't it? I saw the cheapness of that. I thought, wow, it's a steel.
Well, I'll tell you. I mean, basically, they do so. Their bread and butter is sort of next generation axial flux electric motors for sort of like 2 or 3 wheeler tuk-tuks and e-bikes and small vehicles out in Asia, largely India and China, because that's where they really need this sort of stuff. But they also they did a trading update last month. They basically talked also. They've got really excited about electric outboard motorboats for engines for motorboats, plus for high performance cars. I mean, they can outrun when they put these electric wheel things into Bugattis. They can outrun the fastest Lamborghini. So these things are absolutely brilliant. And also, they've been basically looking at other bits and pieces they can do the electric vehicle. They're doing, that's right, I was just trying to remember, they're doing the new replacement in London for the transit van for inner city. Wow. So they've got lots of different fingers in pies. Now, yesterday, this is the steel acquisition they did. And this is really good because it brings a sort of investing principle to all people who are interested. Never become a distressed seller. No. Because Neil Woodford found out the pain 2 years ago.
Well, I didn't realise it was the Evergrande thing. I didn't realise it was connected until I read your article. Is that Evergrande? It's connected. I read your article on it, yeah.
Evergrande, basically the property developer out in China. It's the largest one. It's been swamped under $300 billion of debt, frantically trying to sort of like,
sell everything. Buy this off us quick. Yeah, exactly. We need cash.
It owns about 64% of Evergrande. It's basically the new energy automotive which is listed in Hong Kong. So it owns that. And it's basically over the last 12 months, it's been putting huge pressure on that subsidiary to return cash. Now, unfortunately, Evergrande New Energy has got so short of cash that it actually can't pay its employees either. So it's had to do a fire sale of one of its Dutch companies called E-Traction, and just luckily Saietta knows this really well. It's already been looking at in-wheel electric motors for sort of heavier duty vehicles, for sort of buses and for HGVs and stuff, so it had already done the due diligence. This company, it comes up for sale. They can effectively, on a fire sale, it's going to go, if they're not careful, it will go into administration. They can pick it up immediately. So it works both ways for both parties. So it's a great acquisition. So having done the two or three wheelers, having done the 2 or 3 wheelers, high performance cars, the potential transit, it's now got the technology to do electric powertrains and in-wheel electric motors for larger vehicles, for HGVs, for trucks, and for buses. It's got the whole shebang. And for 2 million euros. I was going
to say, did they suggest how much it would be? Because I can imagine the panic in Evergrande. They're just trying to sell everything. They don't mind if they're probably taking hundreds of the price. Taking massive haircuts on everything, aren't they? They need cash desperately. So bargains galore from that company.
Yeah, look, I mean, I would encourage anybody to have a look at the portfolio of Evergrande and see whether you can pick up a house in Beijing going cheap at sort of 5 compared to a million what it was before. But that was a great acquisition. Again, it just shows you the nimbleness of the management team. I mean, I've interviewed the guys a couple of times, Vic Kiss, the CEO, and I was so impressed by how he was looking at it. And also just look at the endorsements by the shareholders. I mean, when you get going into that IPO, which it was about, I don't know, it was only done a couple of 3 or 4 months ago, but when you get the likes of Andy Brough, Paul Jordan, you get Guy Feld from Hargreave, basically Hargreave Hale or Canaccord, and there's another guy who's also equally brilliant in there as well. So when you get that quality of shareholder who put their hard cash into a business like this, that all the pieces are there. And hey, surprise, surprise, from their IPO price, and I think it was probably about, was it 120 or something like that, if I remember rightly?
So like, yeah, 120.
They're already over £2. But if you run the maths and they get 5% of this sort of like, electric vehicle market, in spite of 10 years, you see this at 10, £12. So again, there's plenty of sort of like firepower behind that one. So yeah, EVs are looking really good.
Yeah, I think all that area, anything. I mean, if you haven't got, so like I said, I think I don't see diversity as in size of company. I see it in sectors, And like I said, my portfolio, I've got sort of exposure to sort of gaming, esports, fintech, medtech, experiential leisure, which is very growing because you've got, literally the kids grow up today are aware of the climate. They're not buying sort of the plastic tat if they can help it. They prefer to go on an experiential leisure, for example. I don't know if you saw this escape hunt, but experiential leisure is growing very quickly. People want to get out there, take pictures of social media and all that stuff, show off and do stuff, and create memories rather than just buying tat. It's going to kill the climate. Did you see the acquisition that Escape Hunt did of Boom Battle Bar, which is quite nice because
what was the logic behind that one?
But essentially, for a long time, Richard and the guys have been talking about there's sites in the pipeline. There's Escape on 19 sites so far. They've got EBITDA sort of cash positive 15 to 17. But they said we are looking at sites, and it's going to be mentioned sooner or later. And everyone kept saying, "When's the new sites coming?" And everyone expected to say maybe up to 5 sites announced in one go. And they came out with the acquisition of Boom Battle Bar, which is the guys behind Flip Out. Flip Out is a trampoline park. My kids go there every pretty much week. It's always busy, but there are 50 sites Flip Out already. But the guys behind that, and it's kind of like a social competitive gaming bar. So there's crazy golf, there's all the darts, there's axe throwing, plus there's cocktail, street food. It's done very well.
Axe throwing with kids.
Well, that's it. That catches all the marketing. It's a very novelty thing, and you're caged in. It's very safe and all that stuff. You can't be drinking when you're doing it, but it's very safe. But they've got 21 modular games they fit into these, into these bars, and they're massive. So they came up with this acquisition straight away. The pipeline went to 21 sites, new sites on top of their 19, and they got a further pipeline of 39 sites there. And most of these Boom Battle Bars are franchisees groups. By the way, they got capital contributions from landlords of 12.6 million. This is going to be profitable in the first half of next year. 18 sites already been signed up by franchisees. Alex, they're just rolling these out so quickly. The demand is massive. And my friend has been the one in Cardiff. He said, I think it's the future of bars. He said, rather than just, looking to do something, then go to a bar and drink, you just go there with your mates, play games, and everything from pool to bowls. There's loads of different games, but it's very exciting. They've got 2 massive sites as well. We're talking like 17,000 square foot, one in the centre of Oxford Street, one in the O2, it's opening very soon. And there's one in Hull, 34,000 square feet. It'll be a Flip Out, a Boom Battle Bar, and escape room. And so there's lots of shared costs. In fact, there's hardly any cost for escape now, and it makes sense because before they had small reception areas, escape rooms with a couple of snacks. Now they've got a proper bar in there, games, drinks, everything. So, and Richard said on the podcast, I recorded a podcast with him this week, said he sees this as an opportunity to create the UK's most preeminent experiential leisure group. And after that, we go further afield. And of course, there's franchisees happening in the US as well. I see it's becoming a big company. The guys behind Escape Hunt are clever. Richard was this chief strategy guy at Pret a Manger, rolling those out. Another guy there was created Giraffe restaurant, sold at Tesco. The guys behind Boom Battle Bars did Flip Out. There's a huge amount of wealth and talent in Escape Hunt now, and they've got plenty of cash. And I see it very exciting. It should transform the business overnight. I mean, no one saw 39 new sites coming online like that, and it's phenomenal. I think it's been really exciting.
You're keeping your 3% in it on it. Are you? You're not changing your holding.
No, I'd be too overexposed in the portfolio if I do that. So I can't. So I've still got 3 million shares in there at the moment. So
did you didn't add to the plate in the placing? No,
I'm going to take up. So as part of the placing and all that, there's a 12 on open offer. I'll take up the open offer probably, but I can't go. It's just having to balance that portfolio. It's my biggest holding now anyway, so I don't want to go bananas on it. But part of me thinks maybe I just should. I've got a lot of confidence in it, but you've always got to realize there's always risks. So so I won't go absolutely berserk. I've got sort of 6 stocks I've got. So I'm happy with the balance for the moment. But very exciting. Very exciting that is.
yeah, as I say, you just got to get the right level of diversification and you know, sort of like, you know, that you want personally. I mean, another one which is a big cap, sort of like, and they say, you know, large companies don't gallop, but AstraZeneca is. I mean, I only bought it sort of like 6-9 months ago. It's up 25%, and the key they put out sort of like Q3 results this morning, and I was just sort of flicking through it. But really, for the big picture, for the sort of principle for investors here, is that actually the shares are up, you know, as I say, 25%, but they're cheaper now than they were when I bought them 6 to 9 months ago, and that's because the earnings have accelerated. The outlook and the earnings have improved faster than the shares have. So they're actually they're on about 18 times earnings for next year, but they're growing that sort of level again, about high, you know, sort of teens next year. So it's about, they've got a PEG ratio of about 1, which for a top quality, you know, immunotherapy business for oncology is just absolutely great. And it just bought Accellion as well, which has got rare diseases. It does sort of like you know, that one does rare diseases. The other ones it's got is sort of cardiovascular, etc. And it's just set up a separate division for its COVID vaccine and for its antibodies, you know, sort of body. So it's the most valuable biggest company on the FTSE. But this one could keep powering ahead for years. I mean, they're going to carry on. The sort of you know, the 5-year outlook for earnings is high double digits, if not, you know, sort of like 20+% increase in EPS for the next 5 years. So I think this one has still got, I mean, I said that when I bought it, this could be 100, you know, £150 a share, you know, stock quite easily.
When did you buy it? Because I remember you buying it. We thought,
I bought it about, I don't know, it was about 70 quid, I think it was, about six months ago. You get a nice dividend. But again, I'll just say these kind of things, if you're just looking for a steady Eddie type of, you know, sort of low risk on the, you know, running on the coattails of large, big global themes, i.e. cancer, immunotherapy, infectious diseases. This one's, I mean, you can't miss it. It's the big, it's right at the top of the FTSE, and it's cheap. At a PEG ratio of 1, this is cheap for such a IPR-rich healthcare giant, absolute giant. And it's, I mean, anyway, I just said. I
remember you buying it, and I was saying these kind of plays like this when it was oversold a little bit, you know, and it was down and dumps hitting sort of support levels. It's almost sometimes when you get companies like this, you can almost close your eyes and just buy it. You know, think over time it'll be fine. It's just having one of those temporary sell-offs. Because when these big stocks start having sell-offs, it's like a tanker. It takes a while to turn around. The momentum, selling begets selling, and that's when you can take advantage, isn't it? And it will take a couple of months to grind lower. It's like same with Boo and Assos and all that, because those companies, it'll take a while, but you know, looking back in a year's time, think that was a buy opportunity. You know, those kind of companies there. You know.
Yeah, I mean, I'll just give you the numbers. I mean, in 2023, I reckon they'll do $8.60, which if you divide by, you know, sort of the, you know, the exchange rate 135, you get sort of £6.37 or £6.35, say, and it's on what, 95 quid now. So divide by sort of like £6.35. Yeah, hang on, just doing it now. Divided by £6.35. I mean, that's 15 times PE. I mean, it's just and they'll be growing earnings. So you just look at it and just think, well, this is a no-brainer, really, because the visibility over the next 10 years of earnings is great. So yeah. Anyway, I mean, I'm happy with both of those big caps. Really, really good. I mean, moving on. I mean, I know you're going to chat to the guy. Oh, you did chat to them. How did you get on with Manolete? I was going to say with Stephen.
It's very nice, Steve. You know, and what I like is someone. I've spoken to a lot of CEOs, you know, and you know where there's spin happening, and they're trying not to tell you. Steve is very down to earth, and he will tell you exactly how it is. He said, you know, they did very well during the lockdown, considering, you know, they couldn't go about their normal business.
They were still profitable. Did you see that the margins was? I mean, the EBIT margins were still 30%. You know.
I mean, just to explain, you probably need to explain what Manolete is. Some people don't understand what they're about. So just to give a top line.
Yeah, I mean, basically, Manolete are the UK's #1 insolvency litigation funder. So basically, they take cases, they buy all, 90% of their cases they work on, they buy from insolvency practitioners. And during the last 12 to 18 months, the government has imposed unprecedented sort of conditions on the industry to stop the courts processing insolvencies for businesses and for individuals. But they lifted that embargo on the 1st of October. And so consequently what happened is that from when that law was put into place in June of 2020, it depressed artificially the level of insolvencies, surprise, surprise, for about sort of like, 9 to 12 months. But then you saw coming into this sort of like the withdrawal of those sort of like unprecedented creditor protections on the 1st of October. The last 6 months, you've seen an increase in the number of insolvencies and the number of creditor voluntary liquidations. And so consequently, and that's really the bread and butter for Manolete. And that,
what I thought was quite interesting there, you say depressed this. You've got two drivers here, essentially. You've got the normal, run rate of the business was suppressed. Now it's going back to normal. And now they've got a sharp increase as well, because of course, the pandemic will create more insolvencies and more problems. So the business will be busier. I mean, did Steve say there will be a bit of a lag before all this comes into play, but it's going to happen. We're seeing a sharp increase,
you're already seeing it through the stats. Yeah, absolutely. I mean, if anybody wants to download the presentation, I think it's on the Vox website, actually.
Yeah,
certainly
he did a presentation as well as on there. And also, what I quite like is that two things. He said, first of all, we're specialists, and this is all we deal in. We know exactly what we're doing here, and we only have to send a letter sometimes. I don't know what percentage it was, quite high. Doesn't even get to court. We send a letter to them. They understand straight away what's going on, and they settle. So,
I mean, basically, it's over 95% of all of all cases get settled out of court. So I mean, and the chart to have a look at is this one. I don't know if you can see it. It basically, anyway, it shows you that the level of insolvencies, it's chart, what is it? I'm trying to look at it. Oh, has it got a number? Oh, it has, a small one. Yeah, 13, chart 13. And it just shows you the industry. And it's now above pre-pandemic levels for the level of creditor voluntary liquidations. That's going to drive the revenues. And just to give you a level of sort of value, I mean, they were profitable even during unprecedented sort of conditions over the last 12 months. That's now sort of gone. I think they could easily do 15 million of EBIT in a couple of years' time, or 2024, etc. On that basis, 14 times multiple, you get the share price of roughly around about £4.40 compared to less than £3 currently. But actually, I think they could beat the £15 quite easily, given the positive operating leverage. Stephen, I mean, when you spoke to him, I guess, I don't know if he told you, he did in the announcement anyway, but he's increasing capacity because he really believes he needs some more feet on the street to be able to process the huge backlog of cases that are coming his way. And just to give you an indication, they've got, that of this market of third-party purchasing of insolvency, of IP insolvency cases, they've got a huge market share. It's well over 50% of it. So they dominate it. They've got the best database. They've got the best experienced lawyers in-house. And therefore, when it comes to pricing risk of these sort of cases, they can do it better than anybody else. And it's a win-win as well, because it helps the creditors. It helps the insolvency practitioners because they haven't got to take the risk. It even helps the sort of defendant because it means he hasn't got to go to prison. So it's a win-win-win. And obviously it helps Manolete, they're doing work as well. So it's a better reallocation of capital. It saves as many jobs as it can do, and it moves things forward rather than getting stuck in a sort of insolvency loop, which is what used to happen before this. What they're doing was sort of like given the green light by the government. So I mean, it's all I would say is that I think this one again is a bit of a no-brainer. It's a small cap.
And what I like as well, I mean, I don't know if you that book about the studies, companies have done 100 bags, and they said there's no real theme, but one of the strong themes was companies that are founded and the founder has a big chunk of shares tend to do very well compared to companies where and Steve owns I think about 15% of the stock, and he founded this, like I said, 2009 there. So he's fully invested. And,
he's got plenty of skin in the game. And another one with plenty of skin in the game, well, I think you've spoken to in the past, but maybe you didn't this week. He's one of my favourites, Suk Chamdal, CEO.
I did a presentation last night.
I
did a webinar with them last night. And
did you? Oh, okay.
Yeah, lovely guys. Worth checking out. The webinar. They did a presentation and some Q&A afterwards. And
what did you make of the results?
Well, it's amazing. You know what? To me, it's one of those no-brainers. They got people want to take franchisees. I don't know, the number was huge. Like, I think it was 50 or 60
62.
People. Yeah, 62 people queuing up to take franchisees off them. Then Asda got like 650 stores across the UK. Once you get into those spaces like that, it's very sticky, isn't it? And it seems to be, it almost seems to be they can't get enough sites that they want to. It's demand there. It's just getting the sites, isn't it? Really, and it'll roll out.
I mean, I know what I'd say is if anybody hasn't put some money into it, is interested in investing in sort of like the UK's go-to provider for sort of like egg-free celebration cakes, which is what CakeBox is, and it's a great brand. If anybody wants to sort of like check it out, just go to one of their franchisee store and try it. I mean, I did, did the secret shopper in August with my father for the 80th birthday, and the product was just unbelievable for people who were at the end of the meal, etc., who are really discerning customers. I mean, basically, my wife, I mean, she doesn't do it, but she's almost a professional cook when it comes to cake. She's absolutely brilliant. She couldn't. It was flabbergasting. She was chuffed a bit. Well, she thought it was excellent. And then her mum, my mother-in-law, she wasn't there, so Anne brought some pieces back for her, and she was chomping into the cake for a week. I mean, she absolutely loved it. So all I would say is that if you've got any doubt, just go to the local store and just try the product yourself out and see what you think. And as I say, the shares have done really, really well since IPOing about 2 or 3 years ago. I think they IPO'd about just over £1.10.
Yeah.
I mean, they're currently £4, but I actually think like, when you ran the numbers, I think the sales for this business could hit 65 million in about 5 years' time. You put a 22% EBIT margin on that, which is 22. They do 22% currently, so it's not massively stretched. And on that basis, you get a share price of over £7. So, there's plenty of juice still left in that, the CakeBox shop. And as I say, it's a very successful rollout of a really good concept. The key, though, when you look, the key is that you've got is that double team between Suk, who's the brains, and the sort of like the heart of the business.
And the salesman,
brilliant.
The first question, he sold me straight away. And the first question he sold me, I said, Suk, stop talking about cake, please, because I'm diving a cake. Yeah, and you really go, and the roles fit them. It's like he
does. And I was going to say,
and CFO is very straight laced, and
No, you got Suk, who's basically the creative heart of the old business and just loves the product and wants to have a fantastic service. You can just see it all, throughout his body. And then you've got Pardit Das, the CFO, who's just basically the financial whiz, the brains behind the whole sort of like, rollout of franchises and making sure there's obviously enough money and capital. And I mean, the cash is just piling up, and they're still rolling out lots and lots of stores. So, he's doing a fabulous job as well. So,
well, they did say they're going to invest a bit more in like marketing, because they've been very low level marketing, but doing very well. But I said, do you know what you should advertise for is a chief cake tester. That would get national headlines, and you'd be people queuing on the block.
That would be a great idea.
I know, but very simple. And in fact, one of my stocks, which is funny, I hold, they got results out on Monday, and this company was written off for a long time. And in fact, people kept talking to me about it years ago, and the old management used to burn lots of money, and it's Gfinity. And I really like what John Clark, the CEO, has done. And these turnaround plays are quite good. I quite look like this because he came on the podcast 3 times. Then we're going to be profitable, EBITDA profitable in the next year. And I didn't really believe him because it was tainted with the old management. There was a lot of cash burn, and he's driven now towards higher margin business, which is digital media, their software as a service, because their esports platform is white labeled for any sort of esports competitions around the world. It's one of the best. And I think on Monday, expectations of 5.5 million, up 21%. This is just a start, but the margins will be a lot higher. And they're looking at top line, they're forecasting top line compound annual growth to 2024 of 48%. And just look at what they do. They acquire these sites that have niche following, and they sort of optimize them. They advertise on them. They grow them as well. They grow the user number and the value per user. And so, for example, they acquired this company called this site called Epic Streams, and it's a very sort of geeky website in December. It had like 500,000 users in December. It's now just hit 3.5 million in October. So the growth of that's now with advertising and all that stuff. So I think John Clark and the team, they've done amazing, but it's just a start. I mean, at the moment they're not cheap. They're going to go for 10 times sales, but they will go to 5 times or 4.5 times sales based on next year's forecast, and the growth is phenomenal. So they will grow into that. And they're doing the right thing, So I'm really impressed. So these guys.
I mean, I'll tell you, when I listen to you now, over this last 18 months, you impress me even more because you overlay that valuation. You say, well, they're not cheap; they're on about 10 times sales. And you're absolutely spot on. They're not that isn't cheap.
No, but if you look at them in the US, I mean, this is like now going to be EBITDA profitable. If you look at the US esports gaming companies, they're like on ridiculous multiples. They're nowhere near any kind of profit
but
at
you
all.
look at the point I'm making is that you're looking at those metrics to get that guide to see how other investors will look at it and perceive it in valuation rather than just ignoring valuation. Now you need to put on sort of like your EBITDA multiples and EBIT multiples and all that kind of stuff, depending on how early stage the company is. If it hasn't got profits, you can't do it anyway. But and
I've got all that, but I've got all that in a spreadsheet. But you are the spreadsheet genius, and I've learned from you there. And it's one of those things. They got huge amount of growth coming forward, and their sites are getting better all the time, and a wealth of talent behind them. The content they create is very good, and like I said, they've done the right thing, focusing on, because before there was. The old management, they're a service provider to big brands for esports companies. They still do that now, but they won't do it unless it makes economic sense. Before, they just did it because they hooked up with like Formula One and all these big names. But now they supply the software as a service. They've got the the digital media arm as well, which is a high margin, and so it makes a lot more sense. So it's it's one of those ones. It's the share price is frustrating because I got in like I think 1.5 pence. It's now 4.5 pence. It's done very well, but it's gone nowhere. It's gone up and down in the last year, and so it's been frustrating. But it will go again. You just have to have a bit of patience. That's it until it grows into that sort of thing. But it will. It's going to work. It's just patience.
Yeah, I mean,
which I've lacked on certain stocks, but I'm not going to lack on this because it could be. Their model, by the way, is Future PLC, and they've got a guy, non-executive director, on with them for Future. They've got ex-Apple guys. They've got a huge amount of experience in this team. So yeah. I've seen the share price of Future PLC. It's phenomenal. It's like wow, digital media. Anyway, go on. What's next?
I mean, basically, just an update on 3 other companies in the healthcare space. First of all, Belluscura. I keep getting more and more impressed by this actual firm. They basically make portable oxygen concentrators, next generation ones. Anyway, they put a trading update about a week ago, and they upgraded their expectations for this year, next year, and the out years, etc. And it's going to be. I mean, essentially by 2025, you've now got the house broker Dowgate Capital saying they're going to do sales of $111 million and an EBITDA of $34 million. That's a margin of nearly 31%. And they've lifted their price target to 150. The shares are about £1 currently. But I think actually, if you look at things, how things could really go. I mean, I said when they IPO'd back in May that I thought the shares could get to, sort of at £1.80 to 220p, over the next 5 years. And I think that's very, very achievable because I actually think, I mean, this is, just to remind investors, a portable oxygen concentrator allows patients who have got breathing difficulties for whole numerous different conditions. It could be COVID, it could be COPD, it could be, sort of like bronchial pneumonia, whatever it is like that, to have to be treated at home, to take all the resource away from the hospitals. And that's going to be one of, again, the huge themes going forward. We saw the stats. It was the first story on the BBC yesterday, was how the NHS is getting swamped, but they're not dissimilar to everywhere around the world. And therefore you can have more sort of like more thrust, more money being put into being able to treat people remotely through telemedicine, or alternatively at home, or giving them a better quality of life through mobile. And essentially, these portable oxygen concentrators hit all of those. So they're really onto that sort of. They're going to be on the coattails of that tailwind across the whole of the industry. So it's a trend that it looks out for. And I say the two, the management team, Bob Rorker and Tony Dyer, the CFO. I mean, they're doing a terrific job. And okay, it's an early stage, company, but they're listed at 45p. They're about £1, and they could double again over the next 5 years. So they're hitting the ball out of the park on that one.
Yeah, they're busy. I know. I mean, what's the news coming out? And think the proper news coming out. Do you think that just shows demand there? Absolutely.
Oh, it's a huge demand, yeah, and that's what's driving the them to increase the expectations. Is that basically the response when they've launched in the States has just been fantastic. Another one which is actually going to have a transitionary year, and I've talked a lot about it, but the shares have been sold off, and it just smells of buying opportunity. Is Oncimmne, and if people, just to remind people what Oncimmne done, it's got this sort of proprietary database of sort of like almost 9,000 autoimmune sort of like proteins, etc., that big pharma need to be able to sort of like help them with their drug discovery, and also for sort of like, to do treatments and maybe even companion diagnostics going forward. But you've got the likes of Roche who are using them, Genentech and companies of that ilk. If they can't do it in-house, it just is a huge endorsement of the actual business's IPR, and they're getting lots of more repeat orders. They've got an order book of sort of a pipeline of 190. I think when I interviewed the CEO, Adam Hill, about 2 weeks ago. So he's got a huge pipeline of potential orders he wants to sort of convert in. And the reason why I am really interested in this company, and I'll probably do some more work on it as much as anything, is that this could really be this year. They just put out a prelims a couple of weeks ago. This coming year could be transformational for them, because this is the year they could become profitable at the EBITDA level on sales of roughly around about, I think it was the brokers on about, the singers on about £12 million, if I remember. They're just getting an increase, and they're spending more and more. They're putting more of the money into, sort of like their customers and to grow in the States as well. So this could be, a really, really profitable. And the reason why, you've got all that operating leverage is the core part of the business, the Immuno Insights service, which helps obviously all of these large farmers. Their EBITDA drop-throughs, when I interviewed Adam, I mean, the EBITDA drop-through is over 80%. It's already, the business they have in Germany, in Dortmund, where the facility is already profitable. So once that continues to scale up, I mean, they did just less than £4 million of revenue last year, but they're going to do 12 this year. And that's the reason why you're going to drive with that operating leverage. You're going to get, it becomes EBITDA positive. So this is a really, really high, IPR rich business in, healthcare, doing lots and lots of sort of like, treating lots of big therapeutic areas, immunotherapy, infectious diseases, autoimmune diseases. But there's no other place, very few other places in the world that have that level of depth and quality of database. And it's getting bigger and deeper by the minute, because the more samples that they process for these large biopharma companies, the better and deeper the IPR becomes. So their barriers to entry become even greater. And these kind of things go for sort of 4 to 5 times book, in terms of sort of like, not book, of R&D investment, etc. So when you run those numbers, you get sort of like over £3.50, £4 a share, compared to, I think it's about £1.80, £1.70 or something like that at the moment. So, and Adam is great. And
but you always expect, though, when you get companies like this that are starting out, but they're very hot, the full year results, they will take a knock, because generally you see some analysts who don't know anything about the company will just look at the top line, look at the valuation, and say, well, hang on a sec, that's 20 times or 25 times sales. What's going on there? But they don't understand that they're going to grow by 4 or 5 times that,
Yeah.
So that's why, yeah.
And also, I think investors got a bit sort of spooked. They had a quiet first period over the summer, because most of their customers actually went away on holiday. But when they came back, and this is what Adam was explaining, when they came back in September, they had a roaring pickup in the level of demand, and that's what they're sort of converting at the moment. So he sounded highly confident in how the business is performing, particularly that. I mean, the key stat is 85% or 80% EBITDA drop through rates for that ImmunoInsights business out in Germany. It's already profitable. So they've got the blueprint. All you need now is to keep priming the engine and rev it a bit further and get more throughput in. And it's up to the big sort of sales guys out in the States to bring those orders, to convert the pipeline, because the demand is massive. It's just a matter of getting it there. And and pricing's very firm on it. I mean, as in, like, everybody pays the same sort of price. And I think he was saying it's 1,000, if I remember rightly, 1,080 euros per sample tested. So it just shows you the opportunity there. And then the last one is a big pharma. I mean, I've already done Astra, but I own Merck. I've talked about that one. And the last time I gave you an update, in that they were the first big pharma to have one of their products, their antiviral for COVID, not approved, but come through clinical trials, 50%. Well, a week later, Pfizer came out with even better efficacy, and so I had a bit of a bath on that one. But but the only reason why I do that is the best reason that I've ever come across to lose a shed load of money on a single day. Is that if somebody has a competitor that has a better antiviral that helps the world and saves hundreds of thousands of lives around the world, then you can't exactly sort of complain, can you?
I know, There's,
but
there's bigger problems in the world. I know. Do you know what? Anything else to mention? I want to ask you one thing. I know you're not a fan of crypto. I think it's a house of cards right now, cryptocurrencies, because the valuation is absolutely crazy and ridiculous, and people try to justify it and all kinds of things. And I think maybe only Bitcoin justified, because it could be digital gold.
Why do you think there's such a divergence of opinion? Because you get some super smart investors who are just like absolutely loving it and really think, I mean, Coinbase, I don't know what the valuation is, but it's absolutely massive. Some people think it's really the bee's knees and it's the way it's going to always happen. It's going to happen. Then you get people like Paul. I think it was John Paulson, who's basically a big guy, and they asked him what he thinks of Bitcoin, and he says it's basically a limited supply of nothing. That was his view. So you get this huge divergence.
But also people have changed their mind, like you're seeing, JP Morgan from the big banks have changed their mind and now hiring blockchain people. So the people do come around, because when you think of it, even right now this week, the Bank of England doing more in-depth exploratory work into digital currency. So we know digital currency is going to be here, and pretty much we are on digital currency. You pay it in binary figures anyway when you use your card online. So we know that they are here to stay, and maybe the decentralized technology is going to be here to stay. But I do say, like the internet boom, a lot of these companies won't exist in 10 years' time. And I did I don't know if you saw that on Twitter. I said it's something like now at the moment, 100 of the biggest coins on market cap are above 1 billion in valuation. 100 of them above a billion. Top 40 are above 5 billion. That's nuts, isn't it? I mean, that's FTSE 100 almost size companies. They got no revenue in these companies. Nothing at all.
If you add up all the cryptocurrencies which are traded, do you know what value you get?
No.
It's bigger than Apple. It's $3 trillion worth of crypto. That, frankly, at the moment, I mean, sorry, I'm just trying to support what you're saying. Is that you've got a huge amount of faith in that sort of like level of. I mean, that's an enormous $3 trillion. Is just frankly massive.
Well, Bitcoin alone is 1.2 trillion. Ethereum is $500 billion. And I'm thinking, okay, maybe there's an argument for Bitcoin being digital gold, because maybe moving from, in this day and age, people don't store, buy gold and that. But there's a lot of these things that will start collapsing, I believe, and it'll bring the valuations down, like in the .com boom, and then at more sensible levels. But I was thinking it's very interesting. If you want to get access to crypto in a more reasonable, valued way, it's probably worth playing an investment company. I mean, if I talked to Blue Star Capital in the week, and they're an investment company. They invest in esports and all high tech and gaming, but they've got a holding in Satoshi Pay, which is decentralized finance. So the market cap of this company is only like 10 million, and Satoshi Pay, their pendulum sort of investment, just raised 5 million in it obviously depends how much they own of that. But if you want a measured way of access and exposure to this area, because it is a wild market. But do you think crypto is sucking money out of the main market? Do you reckon that's happening at the moment?
I think it's definitely sucked money out the gold market. It's one of the reasons why gold prices flattened. You know, even though inflation has been rocketing, we had that last week out in the States with a sort of 6% print. Or was it this week? I can't remember, but it was an enormous number. But the gold hasn't really gone up, and the reason is because you know, people have been, the younger generation have been putting money into Bitcoin, so it's definitely taken out of sort of like, you know, the gold and you know, those sort of like perceived as inflation hedge
it's been down for a while. But it's gold has actually just had a rally last couple of. I mean, it's starting to move now, but it's been behind. Sort of, Bitcoin is seen as a play on, sort of course, inflation. Maybe that's it. I don't know. But
all I would say, with Bitcoin, I don't think it's taken too much out of the stock market. In fact, if I'd say, for anything, I'd say it's put it in, because you look at Coinbase. I don't know what the market cap of Coinbase is, but it's frankly enormous. And you've got so many companies also like Argo Blockchain and people like that. So it's added to the overall market cap of the market. The key. I mean, again, it's a battleground area, and you can argue it one way or another. I mean, I've spoken to some super smart investors who believe that it's really going to do, you know, marvelous. I personally wouldn't be putting my own money into it, but I can equally see, you know, if you do get the regulators giving it the green light, particularly in the States, Bank of England, elsewhere, etc., and you know, those particular sort of, you know, cryptocurrencies are used as, you know, as ways of exchanging money, then it will make sense. But and Coinbase will do brilliantly, because it is that platform to be able to convert across the relevant crypto assets. But hey, you know, you've got to have faith, and you've got to, you know, believe in it. And I was more sort of like a skeptic, but, you know, sort of like 6 months ago. But I'm actually coming more along the lines of that maybe it will be a, you know, these areas, there will be actual sort of profits to be made. But
it's just the ridiculousness of these meme coins, you know. And I think when you think that Dogecoin and then a spin-off, which is a dog essentially, and that's 33 billion. You know.
Yeah, I know.
And you get Shiba Inu, which is a spin-off because Dogecoin was ramped by Elon Musk. Someone decided, let's create another meme-based dog coin, and that's now 28 billion. What's behind this? It's like, no, this is the height of insanity, and people in it don't see it, of course. But I do see it as a .com bubble. It may take a while to pop a little bit, and but I think it's going to go. You know, it's going to go. So be careful if you think this. It is technology, I believe, is the future. Yeah, but not all of these are the future. It's like, you know, with Amazon, even the .com boom, people thought Amazon was going bust. Where's it now? You know, there are opportunities to pick up some good opportunities.
And I would just to sort of finalise that one off. If people are interested in where there's opportunities, software, technology, you know, as I say, I'm not sure it's been published yet, but it'll be published later this morning. Have a look. I strongly recommend people watch, and you, Justin, because it'll tell you about EVs. They basically, when I speak to this guy, Dan Ives of Wedbush Securities, because he takes me through software and technology, not in the next 12 months, but in the next 5 years. And the big themes, the golden themes that he talks about, are cloud, electric vehicles, digitization, and, you know, just general sort of software. And it's absolutely great. He puts firm numbers, and cyber, that's it. And he'll take you through it. And you may, I mean, I'm a skeptic, and, you know, I'm a sort of like a bit of a cheapskate when it comes to sort of valuation. But he even convinced me that Tesla at a $1 trillion valuation is actually not that stupidly valued. And when he took me through it, it isn't. It actually isn't.
But you know what I heard is the reason why these EVs are, Rivian, for example, 100 billion, no revenue listed in one of the best things I heard was that, what that could be thinking different level was that if these batteries become so good, they become a store of energy for your house. So not only are you driving the car, it recharges, you go back, plug it into your house, you can sell that electricity through, or put that electricity through your house, even sell it to the grid. You know, so that's another concept I've never heard of. So that's interesting. So we don't know we know technology is amazing. It'll advance a lot faster. You know, technology enables exponential technology growth. So we don't know where it goes. So that's how do you price that in? You know, that's what's happening with crypto as well, I suppose. Marvelous, Paul. Thanks for that, fella.
Yeah, take care, Justin.
See you in a fortnight.
Cheers, then.